The past week has been very turbulent in terms of financial fraud discussions. Now, I don't want to claim and go ahead and pass a judgment saying financial fraud has happened or has not. However, there has been two very strong incidents by two extremely prominent players in the market, which has come to light. The first one is a conversation about Grow, which is a brokerage firm, and the second is from a mutual fund house called Quant. Now, both of these are under active investigation, so there's no judgment as such. However, there's always the, case of public opinion that's getting built, and I'll want to talk about it. The intent for this video is not to get into the absolute details of what happens. This is not investigative journalism, but the intent for this value is to educate. This conversation is to educate and bring up to light that these things can happen and these can happen to anyone, and how do you protect yourself from it. So let's move on to each of them and understand what has happened. And this could have happened to anyone, and the fact that this has come to light is extremely important that you understand and measure the risks. Regarding risks, I've talked about in my previous video about how can you manage risk. There's a great deal of content. How can you do position sizing and stuff. So if you have not watched, please watch that. All of the code and everything, all of analysis, stuff like that, details will be shared in the member channel, which I've recently introduced. So please join if you have not, as well subscribe and like. Let's move on. So the first one has been around Grow, and what Grow has already done is offered the user a refund after some allegations of fund deduction has happened. Now, going on to the source, this is what is the article that has been being circulated in LinkedIn and now on Twitter. So the person has tagged, which is Hanendra, and he says that his sister has made certain investments with a mutual fund house, Parag Parikh, using Grow like back in 2020, which is 4 years. And what seems to have happened is that some sort of folio number was generated, some sort of data was displayed on the dashboard and whatnot. However, when they went on to redeem it, they could not, and they were not able to. So while they have been compensated, and I think he has finally provided an update that after multiple talks and discussion, they have finally accepted a mistake. Now, whether a mistake has been truly accepted because it has happened, or the mistake has been accepted just to avoid bad publicity because this was becoming huge, that is still to be known and seen. However, they have provided a resolution in the form of a credit refund of the amount which was in question. Now, again, they're trying to remove the social media post and all that. That would obviously be the case. One thing which we have to understand is that any appreciation that the person could have had, and Parag Parikh is a great house, and past 4-5 years, they have had great returns. So that is obviously a loss to the person. So while the original principle is being covered, this is a significant risk in terms of investment. The second one is in the case of Quant Mutual Fund, and this is more complex nature. So there's a concept called front running, and let's take a quick look at what front running is. This image is from Wall Street Mojo. I've just picked it online. There's no, it was on Google. It's a very straightforward concept where, let's say you are a customer to a mutual fund house, or it can happen anywhere, right? It can happen with PMSs and anywhere where, your money is being managed. So anyone who is in a position to manage money can actually do this. So let's assume you're a client or a consumer to a mutual fund house in this case, and the broker essentially wants to get some sort of benefit out of it. So what they need to do is, they know that their AMC is going to make some bulk buys of 100,000 crores or 1,000 crores or 100 crores, whatever be it. And specifically in the case of small cap, mid cap stocks, which is large portion of what Quant Mutual Fund was doing, that could be a significant amount of money. So if 40-50 crores are being pushed by a fund house, that could be a significant boost to the stock price of that specific stock, or even in general the whole mid cap and small cap segment. Now, what they will do is, let's say the price is at 100, they will first place an order from their own account and buy, let's say 1,000 or whatever X number. And then they'll go and place the order based on client's behalf. So before putting that 100 crore into X or Y stock and riding on the curve, what the person or what the broker is able to do is make that delta increase. So whatever investment they made, they would make bigger returns compared to their clients. And that's a regulatory no showstopper. So SEBI is currently investigating this. And because of this, there have been impact on the NAVs and there have been a lot of redemptions happening. Now the redemptions aren't कि चलो सब कुछ बेच के चल देते हैं type से. The redemptions have been say still 1% 2% in the category, so not a lot of dent, but again it's a significantly bad press. Now 5 minutes into the story I've understood all of the history. ये क्यों जरूरी है समझना, क्योंकि this can happen to anyone. We all make investments using these technology based platforms and technology literally is powering this. But now the key concept or the question is, how do you protect against it? So Mint has put together a great article, and I was, putting my own thoughts. But again, I felt that Mint has done a substantially amazing, article in this space, and they have given a very good synopsis. So given the complexities and pitfalls in digital investing, they are trying to bring 6 points. The first is diversify your investments across platforms and account. Avoid putting all your investments in a single digital platform, use multiple brokers, use different accounts, and that will help you mitigate some sort of risk. If you have all your eggs in one basket, well, if the basket falls, all your eggs break. Monitor investments, and I'll show you how to do this. So you should stay vigilant, and the idea behind this is you have a lot of services like CAMS, CDSL, NSDL, and there's something like MF Central also. Again, I don't know if it's regulatory or not, but they provide a consolidated view in your portfolio. So you will get emails like this. For instance, this is a stock split that has happened, and I got a simple notice about it. And these mails are a constant to me. Like I'll get 10, 15 emails from CDSL a day because I'm an active investor / trader. So a lot of these emails are coming. Now, this is a proof that the broker has registered or done its regulatory duties with the government bodies associated and trusted third parties associated, like CAMS, like CDSL, like NSDL, and things like that. Now, these entities are kind of helping you do independent verification, which is significantly important. So if you are, in mutual funds, get your CAMS report every month, get your CAVI report every month. Keep a log or a folder in your, somewhere, because we all do SIPs, right? And keep a record of those CAMS statement in your mail. Don't delete them. Add appropriate email tags if necessary, so that when required to filter, you are able to do it. And every month, or, if it's too much, monthly, every 3 months, make sure you look at your investment. The easier route to say is, I don't have time for it. However, you are putting in time to make money. That's true for most of the people, right? So if you are putting in time to make money, it's important to monitor your risk. And this is a significantly large kind of risk. It's a regulatory risk of nature. And if something goes wrong, if one of these guys default, a lot of money is at stake. Keep detailed record goes on to the same point about get into a habit of logging your own trades, journaling them, making sure you're cross-tallying your annual reports. If need be, hire a CA and make sure whatever your DMAT movements have been, whatever your holding statement is for the year, they tally it against the movements in your account if dividends have been paid and all that. Verify transactions promptly. It's very difficult actually to do that because a lot of people are in the habit of having small SIPs. So we'll have like 2,000 rupees SIP, 5,000, 10,000, and we'll trade in unless you're a big time trader, we'll trade in once in a while with 20,000, 50,000, small amounts of money, right? Where when we get extra money, we tend to invest it. Verifying these transactions become difficult because, we are not used to looking at our bank statement and saying, ki ye wala transaction 3,600 rupees ka hai, ye hai. I would suggest, if you can, get professional help, some sort of a service that can help you achieve this. It's worth paying for all of that. I've talked about that in the previous video. So do check that up, which is this point, right? Seek professional advice. So always seek professional advice, specifically when you're managing your finances. Absolutely worth the money. Stay informed about regulations. I think once in a while, most of us don't want to study that, but subscribe to something weekly, monthly, which can give you 15 minutes in a week to study about what's happening in this space, and you'll be able to cope up with it. And I think with a summary, like the guys at LiveMint have done, while digital investment platforms offer convenience and great accessibility, incidents require the importance of due diligence. So make sure you diversify, make sure you track things, get professional help. Do track your money inflow, outflow, any changes happening like the one that I showed, etc. And make sure you keep investing. पैसे कमाते रहो. चलो, all right, bye bye.